Good morning. Thanks very much for joining us here as part of the Real Asset Live sessions and program that we're running here at the International Investors Lounge, live at EXPO Real. If you're joining us online, thank you very much for joining us. If you don't know me, my name's Richard Betts. I'm head of content at Real Asset Media, and we're focusing on, I guess, the research, the analysis, the market insight, the kind of things that are driving investment markets, and we're looking across all the sectors. And obviously, logistics is one of those, along with living, that has been a big focus in terms of investors for some time now. Let's pick up, first of all, with just some quick introductions. So, Kieran, let's start with you. We'll work our way down just briefly on who you are and what area, I suppose, of logistics you're involved in, whether that's the investor side, the developer side. So what perspective you're coming from. Kieran.
Yeah, thank you, Rich. So Kieran Farrelly, I'm the Chief Investment Officer at Schroders Capital Real Estate. We invest, on the investor side, and we manage a number of industrial estates, logistics assets across the European region, particularly in the UK and Netherlands.
Great. Ingo.
Yes, very well welcome from Swiss Life Asset Managers. We are a developer investor platform. We are a great partner for communities, for municipalities, for investors, and we are building a strong pipeline for logistics here in Europe. And we would like to expand the business through all European clusters in Europe.
Great. Balazs.
Hi everyone, I'm Balazs Lados. I'm Managing Director at Realterm in Europe. We're an 11 billion euro global investment management firm. We manage discretionary fund vehicles and we invest in a subsector of logistics, in transportation logistics real estate. That means anything that facilitates the movement of the freight as opposed to the static storage. In Europe, we're around 1 billion euro in terms of AUM. We're in 6 countries and we have about 40 people. Our headquarters in Amsterdam.
Great.
My name is Bert Hesselink. I'm Group Client Relationship Director at CTP. We're a developer and owner-operator of business parks across Europe that are used for logistics, manufacturing, and high-tech operations. We have 12 million square meters, 10 countries, land bank of 25 million square meters, and we are building at the moment 2 million square meters of logistics space across Europe.
Great. So as you can see, we've got a really good mix of perspectives here and a lot of focus on the European markets, and also good to have you, Kieran, here because you can also tell us a little bit about, from Schroders' point of view, how you see logistics within the overall strategy in terms of the business. Let's start just with a general question, and anybody can pick this up, which is how do we see things versus the same time last year? What are the kind of key changes that we've seen? Where are we in the market now? Feel free to pick that up, and also I'll set a rule that you don't need to wait for me to ask, that you can also just come in with your own perspectives. But let's maybe kick off with you, Balazs.
So I think that the worst is behind us. Last year was pretty, negative. Attendance was probably half of this at Expo, so we definitely see a pickup in activity. In terms of our own activity, we grew from 600 million to 1 billion, so we've been continuing to invest in our type of space. We launched a new value-added fund, and we have grown from 25 people to about 40. We started to regionalize our presence in Europe, so previously we were only in Amsterdam. Now we have, an office in London, in Milan, Paris, and Frankfurt. So all I'm saying is, we've been growing our platform despite the negative headwinds, and we see kind of the light at the end of the tunnel. Investors are interested in logistics in Europe. Probably besides the living sector, it's the only one that is really gaining traction. And our investor base is typically from North America, but we managed to attract investors also from APAC and the Middle East into Europe, into logistics.
Okay, good. And Bart, maybe from your point of view, I guess what are you seeing, and also, has there been a change since we've had the interest rate drop? So anyone's perspective on that, but let's start with you, Bart.
Last year, I think at the end of this discussion, I asked, what do you expect will be the biggest trend for the next 12 months? And if I remember correctly, I said something like de-risking of supply chains. that's going to have a big impact on demand for warehouse space across Europe. Now, 1 year later, it's definitely happening. We see it within our portfolio, increasing demand for manufacturing operations in Europe, not just Central and Eastern Europe, also Germany. And I repeat that we're still at the beginning of what we're seeing right now.
Yes.
We are about to make a few big announcements of big transactions we're doing with not just Asian clients setting up manufacturing facilities in Europe, but also European companies opening up new factories within Europe. And you talked about like the lower interest rate. We see the impact of that on the occupier side, that we see an increased demand for space, partly driven by lower interest rates. So companies are now more interested to make investments and to get ready for the next phase of growth.
Okay, interesting. I'll pick it up with you in a second, Kieran, on how you see that. But I suppose also for you, Ingo, what's your sense of this? Do you see? I mean, like Balazs said that there's been a change. Are you also seeing a change in the market now, a new dynamic?
Yes, absolutely. I can only highlight what Bert has already announced. I think we're in the beginning of the next cycle. I think the cap rate sees again compression. We discussed that in our talk before we step into this discussion about the financing costs. The financing costs are at the moment at 330 basis points. That is, in comparison to cap rates, that has a great impact on any investor's sentiment. We see a lot of occupier coming back to the market. You need to look carefully at the location you are in. I think at the moment we are concentrating more or less on the western part of Europe. Locations like in the Rhine-Ruhr area, like in Stuttgart, like in the Munich area, where we have still very strong demand. Vacancy rates in European markets are at the moment coming from 1.8% in average now to 3.3%. That is nothing in comparison to other asset classes. Coming back to your question, what's going on? I think there are two assets which has absolute demand from the investor and the occupier side. That is multifamily, that is logistics, and we are really great to be in that business. Yeah.
Okay, great. Kieran, let's pick it up from your point of view. Obviously, also you're looking at some of the capital flows, and I'll be interested to see other people's perspectives on that. But how are you seeing logistics within that overall strategy, I guess, for Schroders?
Yeah, sure. So I'd say, first of all, from a capital market perspective, and the valuation and pricing adjustments we saw sort of from the end of the summer onwards, 22, I think it's clear the yield expansion is probably finished, right? I don't want to start calling bottoms or troughs, but you certainly feel like values and pricing is finding some sort of a floor. There's some evidence already, for example, in the UK, of pricing actually going in the other direction. Okay, and so we're seeing some positive valuation movements in part of our portfolio already. So feel very good about where the capital market sits versus last year. Sort of interesting to hear the occupier perspective there. Sort of, you feel a little more, dare I say, certain. And we think there's a lot of value to be had in industrial in particular. So we're very supportive. So in terms of where does it sit within a portfolio, first of all, definitely an overweight for us. And we'll, I'm sure, get to the nuances of the different strategies, because I think sometimes in our world industrial gets treated as a homogenous blob, and there's a lot more to it than that. So an overweight, and it's increasing part of a portfolio. So we're seeing, given what's happened, office and retail is sort of starting to diminish and obviously being targeted for reduction. But if you take a typical UK pension fund, over a third of their portfolio now is in industrial, and that's heading more towards 40% than going the other way. So it's a very significant part of institutional books, and it will continue to grow, in our view.
Okay, interesting to see that focus within the pension funds and the investment capital. Yeah. And I guess you mentioned a little bit, Bart, and I'd be interested to hear other perspectives on that as well. Differences in supply chain, nearshoring, geopolitics playing a role, obviously, there. Are we seeing more nearshoring? Is that something that we're actively seeing? Are we seeing changes in terms of maybe even some of the logistics destinations and locations? because of changes in supply routes, more maybe to the Netherlands or Southern Europe, for example. Does anyone have a view on that?
Yeah, there's a lot happening in the world, right? So no doubt about that. If you look at the ports in Europe, the ones that are growing the fastest are the mid-sized ports. So Gdansk in Poland, Koper in Slovenia, Constanza in Romania, and a few more. As supply chains are adjusting to geopolitical risks, the impact of these geopolitical risks are that companies are looking hard to de-risk the supply chain, changing routes, adjusting their manufacturing footprint. That's happening now. And then as a second phase, the impact it will have on supply chains is going to be the next step. That's why I said we're just in the beginning. So
Yes. I can only underline again, Bert, your view. We are concentrating on port facilities from your home country, for example. Rotterdam we find very attractive. For example, it's as well Antwerp, Hamburg is a destination. The charming one of warehouse or logistics is that it's always running. You mentioned that a lot of things are happening around the world. At the moment, the strong occupier are unfortunately from defense, for example, from battery recycling. That drives again the demand for warehouses. The next cycle will be again, if the customers are getting stronger because the inflation goes down, it will be again e-commerce. So it is a tremendous success factor for our business, and it's still accelerating. The service level on e-commerce will grow. What you need is warehousing, it's logistics space. So we're very, very optimistic about our asset class.
Okay, good. Let's pick up a little bit in terms of, we mentioned the strategies before, Kieran. I mean, what are we seeing in terms of money that's active in the market? If we're looking at the international capital, let's say, is it core strategies? Is it value add? What are people looking for? Because there's obviously, we'll pick up a little bit in terms of transformation and that side coming from sustainability. But what are the strategies that are actively looking for access to the logistics sector?
Yeah, no problem. Some of it I alluded to before. So the industrial sector and the way that we would have thought about the retail, we still think about the retail sector, where we can think about shops, shopping centres, retail parks, and all the different sizes, formats, what it caters to, where. We're now starting to see investors increasingly understand all the different facets of industrial real estate, so whether it's distribution facilities, B2B, B2C. I'll let the guys from Realterm sort of talk about what they do, because that's an increasing part of the pie, and I think will continue to be so. So we're first of all seeing investors think about their industrial exposure in a more nuanced manner than perhaps they would have done previously. One, the larger investors certainly still looking at platform opportunities, and I think we'll see a bit more of that. Both in Europe and stateside as well. That will continue. And then to answer your question on risk profile, our sense is sort of core plus value add, but that sustainability-led upgrade plus development piece in a still relatively undersupplied sector, and particularly then when you start overlaying the needs around renewable power, EV charging facilities, all of that, we think there's a great value add opportunity in the sector, and investors are definitely seeking that.
Yeah. Good. And Balazs, let's pick up on your model, because there are interesting things as well around, signs of increasing activity on the retail side. Retailers becoming more active. Sentiment in that market seems to be improving, which should also lead to more of a focus on that retail distribution side. But I suppose, what are the drivers in your market, Balazs? Let's pick up that.
Yeah, so we have about 400 transportation users globally, and most of them are network expanding. They're investing in automation and also in fleet expansion. So that means they need capital and they need it today. So what has been happening is they've been selling off their real estate to investors like ourselves, or actually they're going to debt funds. Debt funds are our biggest competitors now, which is pretty interesting. So we have all these users. We heard about kind of the sources of demand, and they all want to expand. In terms of the appetite for investments, I mean, value add has been high on the agenda. It's really hard to find anyone core. I mean, they're busy with resolving their issues around offices mostly. I mean, any manager or any investor that has a great exposure to office buildings in the US or in Europe, they're struggling, especially as they come up to refinancing. So those groups are out. and everyone moved up the risk curve. So what previously was a 7 to 9% target for a core strategy or a core plus, that moved up to high single digits. Value add moved up from 11, 12, 13 to 14, 15, sometimes 15 plus, and opportunistic is up in the high teens. So, market has repriced, perhaps in logistics, 200-300 basis points depending on your location, but the appetite for return has also increased with that.
And it was interesting to see, I mean, you mentioned M&A there, Kieran, as well. Interesting to see Segro taking over, of course, Eurobox REIT. Is that a reflection, do you think, of difficult to access product in the market, so therefore mergers and acquisitions is a way of doing that? So what's the situation in terms of being able to find product? Is it there for you to be able to access? Who are the buyers, who are the sellers?
That's a very good question, Chad. When you would like to have an exposure to logistics, it's always the question, how are you doing that? Are you going on a single asset basis, being in a tender process with 30, 40 investors, then you always pay the price which is too high from my perspective, or you are cooperating with general partners as limited partners, that you have a platform business like you from CTP have, what we are now growing with the Slav asset managers, being one of the top 10 investors worldwide. We are inviting logistics investors to us, that we are operating, that we are developers, that we can make the returns they are asking for, 12-50% IRR. With developments, it's not an issue. And now, with you new product class, we really like that, that you do an underwriting which is understandable worldwide. That brings again investors' interest to our biotope. We like that very much. So I think, from my perspective, if you have a big pension fund in place, who have a clever operator, who can invest in logistics and development, that makes, from our perspective, the most sense.
Okay, so more of a focus on development in order to be able to get the returns
yes.
that investors
because
are looking for.
you see at the moment, again, tender processes. I think from Schroders Capital you can see that. You are within 30, 50 parties in reversionary games at the moment. But having an exclusive partner who can do development as well, then you get best product, having maybe some letting risk. You need to look carefully at the logistic clusters where you would like to be invested. But that's the very smart way going forward.
Okay, good. But from your side, what are you seeing in terms of access to product? For you, is that a challenge? Who's selling? What's happening in terms of the market from your perspective?
We've been extremely active in Germany lately, and we continue to be active in Germany. We are buying brownfields from large German corporates who are looking for cost optimizations, no longer needing assets that were built 50, 60 years ago. Most of the time in very good locations, talking about 33 hectares in the middle of the Ruhr area in Mülheim, 22 hectares in Wuppertal, Stuttgart, and we see those opportunities to acquire these very well located assets as part of a big transformation that the German economy is going to go through. And what we're doing is to then use these sites to support this transformation of the economy, basically, by replacing these old buildings that are no longer needed with new developments that are needed by higher added value activities that are typically a little bit smaller in size. And that fits perfectly well with our park makers concept, where we develop multiple buildings, different sizes in good locations. And this is where we are investing a lot of our money at the moment, especially in Germany, on top of course, investing money into our own developments on the land that we own, typically in and around our parks. So typically we acquire 30% and the other 70% we develop ourselves.
Okay, good. Be interesting to pick up. You mentioned there the development and the asset buying. I guess, is financing something that people are using at the moment? Is it accretive in the market? Maybe pick up with you, Kieran, on that. Is that, how much financing is being used? Is that an issue? Is it a challenge in the market at the moment, or is it perfectly fine to get financing for development, let's say?
Well, first of all, from a lender perspective, it's firmly one of the preferred sectors. So I don't think, no problem, offices you'll have a different consideration. So first of all, if we're talking about anything standing, reasonably stabilised, no problem getting conventional mortgage finance, yields at a level where we feel you can make a positive spread as well. So that all adds up. The development funding, I think, is there. It's just like anything. It's the banks are more risk averse than they have been for a number of years, but it's available. And particularly anything that's got that strong sustainability profile. There's a lot of green finance options available, particularly for industrial logistics.
Okay, so this is the type of development that it is, and for transformation.
Absolutely.
And I would like to add something on that. Even on speculative development, if you have the right place, the right spec, institutional product, you get 50% LTC. If you have in Stuttgart or in Düsseldorf or in Ruhrgebiet, I think it's not easy, but you need to have a good sponsorship. Then you get financing there. LTC is not an issue for that logistic asset class, even on speculative scheme.
Okay, good. And that's actually a change, I think, from last year
Yes.
as well, in terms of the availability of finance.
And I think the margins have tightened in a bit since then as well.
Yes.
Yeah.
Absolutely.
Good. Just in terms of some of the other kind of fundamentals in the market, there's been a lot of rental increases over the past year. Does that have to stop at a certain point where the occupiers just say, okay, that's enough and no more, I can no longer afford that? Or what's the situation? Will that gradually pick up, or is it, because there has been less development? It's interesting to hear that there's more development and spec development, but actually there has been a pause, so there's going to be less product on the market, which would normally drive up rents, but rents have already gone up. So where are we, I suppose, in the cycle of that? If anybody wants to pick that up.
Well, yeah, it depends completely on each market where the rents are and if they've peaked already or not. If you look at it geographically, it's a little bit mind-blowing that there's such a huge difference in rents, and you're talking to the same large occupiers, for example, and they're willing to pay 10 times higher rent in the UK for the same building as in Poland, for example, and it's not an issue. I'm exaggerating a little bit right now, but the discussion on rent is just a matter of demand and supply, and if it becomes too expensive for a company, then they will find ways how to work with that. For example, implementing high bay storage in order to reduce the amount of square meters they have to rent. So the market always finds itself, and it also depends who you're talking to. Yeah? So we have clients, big logistics companies, rents, yes, are a huge component of total operational costs. But you talk to a retailer and you talk about what's the percentage of rent you pay for your logistics warehouse space as a percentage of total operational costs. That's below 10%, yeah? So if the rent is a little bit higher, yeah, they find a way. So,
if I may put that into a bit of a global context, transportation users have even lower percentages, 3 to 5%. And if you look at a cross-dock in the south of Paris versus one in New Jersey, the difference is 10x compared to the US. So there's quite a bit of leeway for the rents to run still. But what we found in Europe, it's very spotty. You need to know what and where you're buying and where you have that growth and where you have the ability to push those rents. And in our portfolio, we've seen a bit of softness in the UK, in the Midlands, and anecdotally we heard from peers that the Nordics have softened slightly. But other markets like Barcelona, Paris, Amsterdam, they've been massively increasing. We had a vacancy in Amsterdam that it was vacant for quite a bit of time, but the headline rent went from 65 to 95 in 18 months. So what happens is that occupiers take longer to decide which space to take. Decision-making times are longer, but rents are still increasing.
Okay, good, interesting. I'll drill down a little bit in terms of the locations, because it was interesting your point, Kieran, about that it's not just about a country level, not even necessarily a city level, but it's really looking at as a asset and location by location. So I suppose, how is that playing out for everybody? Has that removed some of what would have been the old hotter money in the market? Because actually now you've really got to work in order to get the right investment and a sustainable investment going forward. And I suppose, are the occupiers driving that, or is that you as investors and developers that are driving that where you're focusing on?
I'd say both. I'd add regulators, obviously with the sustainability considerations coming in, and I think just picking up to some of the points made before in terms of the rent's contribution to aggregate operational cost. I think if you look at logistics operators and they're electrifying their fleets, the power cost is a far bigger, I think, concern and has a bigger margin implication than the rent, which doesn't give us as logistics owners and developers, or industrial owners and developers, a rationale to start carving into margin, because there will clearly be a sustainable level for everything. But I think considerations like energy costs are actually a bigger headache today for a lot of occupiers, for example.
Okay, interesting. And that actually came through. There's at the beginning of September, I'm always looking out for Savills do a European sentiment indicator, and Garber also do their pyramid research. And in both of those, power and efficiency, those kinds of things were coming up as very, very high in terms of investor concerns. Interested to pick up that point also around locations, but if you've got a view on that. But also let's pick up on that power point, because is that an opportunity for investors to be able to take that element and actually provide power directly to the customers at a level which means that there's guaranteed power from wind farms, PV, whatever it might be, so it boosts the sustainability, but also is more attractive for tenants. So it'd be interesting to see people's views on that, really.
Yeah, I would say that power availability is also extremely important, especially in the Netherlands, for example, where there's areas where there's just no power. So just the fact that you own a building that has power is already a unique selling point. And then if you're in competition with other buildings that also have power, then you need to get your mind around, okay, how am I offering this power to my tenants? And it's not so easy, but if you get your head around it, then you can really turn it into a unique selling point for your property. We are at the moment in Amsterdam, where we have a large multi-story facility, City Park Amsterdam City. This week, we're increasing the power from 5 megawatt peak to 10 megawatt peak. On top of that, we have 5 megawatt peak available of solar capacity on the roof. And we're talking to companies that are telling me, we want to be in your building because we are electrifying our fleet, not just last mile vans that have to be electric driving into, in this case, the city of Amsterdam, but also our trucks that will drive from our distribution center to this city hub. They will also be electric. So I need to know for sure that you will have the power available. And can you please also install for me some DC fast chargers for my trucks? So it's becoming part of the whole value proposition. And if you own a building and you cannot offer that, then you're no longer being considered by this company.
Okay, so that's a big potential change coming through. There's a session later on this afternoon dedicated specifically to sustainability and logistics, so I won't cover it so much here, but I think it would be interesting just to touch on the demand side, that it sounds as though that argument has been won and the market in a way and regulation has pushed that sustainability, certainly from the E side, and maybe we'll pick up certainly more on the S and value add side in the second one, but certainly on the E side, is that now one, there is no discussion, it's driven by investors and tenants, and everybody's on the same side? Is everybody aligned?
If you want to be successful, I think so, yeah. And if you want the liquidity of an asset at the end, absolutely so. Debt and equity.
Yeah, lenders are offering sustainability premiums now, so if you invest in certain measures, you will get a lower margin, so that's great. Tenants want it. All of the users have net zero carbon plans, so energy efficiency measures, you just need to do it. It becomes similar to a technical DD. It just forms part of your diligence. You need to build it in your cash flows, and where regulation is stricter, then it's obligatory. Other places, your tenants, lenders, and investors will require it, so it just becomes the norm. But you can also use it for, extending leases, driving your income, making certain measures with your tenants, and that can drive your returns as well. So it's also a tool to create value.
And I would add, just increasingly being embedded in the valuation process as well. So every aspect now, it's there.
Okay, good. Just quickly, in terms of the, I suppose, the differences between big box, urban logistics, are we saying different people looking for that in terms of the investor side, different demand cycles for that? Any views on that part of the market?
I can maybe start. So we do see investors kind of going away from a generalist industrial allocation. They will start to look for more sharpshooters in certain segments of the market. We, for example, are heavily exposed to industrial outdoor storage, and we're kind of a first mover in a pan-European scale in that asset class. But some prefer, data centers in Germany, or, city logistics in big urban populations in the top 5 cities in Europe. It really has, migrated from a generalist, I allocate to logistics and industrial, to these kind of strategies where they set up a JV with a local shop that can, ramp up a portfolio of 200-300 million, or just going to Blackstone that will, give you a massive diversified exposure. So I think it's changing, and industrial and logistics is very diverse, and it has its own little niches, and there's certainly appetite for that.
Okay, good. And Bert, it'd be interesting just to pick up on where that sits for you as well, because I know there's a growing focus on light industrial, which often isn't talked about. How do you see that within the sort of general logistics investment side? Because industrial and logistics became just logistics for quite a long period. So how do you see that part of the market?
Yeah, we believe in a mix from every aspect. So we have more than 1,000 clients, and in terms of use of space, 50% is used for distribution logistics purposes. The other 50% is used for producing things. And this is at portfolio level, and also at park level. We like to mix it up. So we believe that is a more future-proof, that is the most future-proof, sustainable investment strategy. We develop for ourselves, keep it in our long-term ownership. And that's also our value proposition to municipalities. Today, it is maybe pharma that you want to focus on, and tomorrow it will be automotive. And then it will be e-commerce. So a couple of years ago, we were asked, why don't you have more tenants that are active in e-commerce? And now investors are happy that we are not overexposed to e-commerce. Now they're asking us about automotive, and we're happy to tell them, yes, a big part of our portfolio is used for the automotive industry, but it's only, again, like a part. So we very much believe in a mix.
Okay, great. There's about 5 minutes left, but does anybody have a question that anybody wants to pick up? If not, I've got a final question for everybody, which is glass half empty, glass half full. Where are we? Are we positive about the sector more generally? And I suppose, where do we see it heading in terms of the outlook for the next 12 months? Are you positive about it? Where are the opportunities? Let's start with you, Kieran, from your perspective.
Half full, definitely. I think a lot of it touched on here already. I think, particularly around the sustainability, that upgrading, development piece, aggregation. I still think there's plenty of room, for example, for some big pan-European owners, operators of these assets.
Absolutely.
And I think there's plenty of room for that, particularly when you contrast Europe to the US. So I maybe we see one or two more, and a bit more M&A by this time next year, perhaps. And then the other piece is just, again, which we've touched on, is just this investors looking at this homogenous industrial blob, if you like, in a much more nuanced way, and thinking about the underlying, tenant bases, the use, some of the sustainability aspects of all of that wrapped around it. So I just think more and more in portfolios and big opportunity from here.
So really targeted approach going forward.
Absolutely.
Great. Ingo.
Yes, I'm not at half full, I'm 75 full, no? Because I'm absolutely optimistic. Because
That's what I wanted to say.
Yeah, okay. Then you can say 80% maybe.
You
and
have
something.
overflowing.
Yes,
Well,
absolutely.
you two are all in anyway, so yeah.
Because I think starting the business, I think 25 years ago, where we were at cap rates at 12%, 30%, no? At the finishing of the last cycle, we were at 3%, or even we have seen in the Leipzig market 2.9%. Now we were at 5%, maybe in some market at 6% in UK, maybe. Prime yields are again at 4.5%, and it's again decreasing. Two sectors are working worldwide: multifamily and logistics. If you ask me, do we need in 10 years a logistics warehouse? Yes. In 25 years? Yes. It will be always this big box where you can put something in. So it cannot be one. If you do it right with a great operator like asset manager logistics, absolutely fantastic.
Great.
Two.
I think the best buying opportunity was 2023. You could pick up product 30-40% discount. This year, there are more groups. 25 pan-Euro portfolios will be back. That's my prediction.
Okay, so still good time to enter the market from your perspective.
Yeah.
Okay, good. Bert.
Yeah, so 90% then I'd go for that.
Yeah.
And I didn't say too much about it yet, but we're extremely positive, especially about the prospects for Central and Eastern Europe. We didn't talk about that's related to sustainability, but we see that there's a big demand, a driver for demand for warehouse space is also related to the energy transition we're going through. We are building warehouses now for companies that are producing things that weren't needed, didn't even exist a couple of years ago, and are now needed to get us through this energy transition. So that's definitely having a big positive impact on demand. And what was also not talked about yet, but it's causing a lot of havoc and change in the market. And as a result, we take advantage of that because there will be a need for new space on the back of cost optimizations. If you talk to companies, big corporates at the moment, that are active globally, they will tell you the two things that are top of our agenda right now. One is decarbonization, so we talked about sustainability, but what is honestly more important is cost optimization. There is a huge competition coming in from China, and that is forcing companies to seriously become more competitive and optimize their costs. And as a result, they will also look at where do I produce, what do I produce, how much space do I need for that. The positive thing of that is that it's creating demand for new space. So for us as a sector, logistics sector, very positive.
Great, really interesting. We've got some super topics coming up as well, so we'll definitely pick up on the sustainable logistics. Next, we're going to be looking at global real estate trends. So that is picking up on the research side, some of the macro trends that are driving the market for 2025. So very interesting to see that. Thanks very much for sharing your insights on the investment markets, and I'll definitely pick that up and take it through into the next sessions as well. Thanks very much for everybody joining us here in the room, and also thank you to everybody joining us online. And if you're watching this on demand, thanks very much for watching.